Greg Tuorto is a small-cap portfolio manager at Goldman Sachs Asset Management. He runs a firm's small-cap core equity ETF listed under ticker GSC. Greg, welcome to the show.
Thanks for having me.
Before we get to the picks, because we do want to get to them, in terms of the rate environment, what do small caps need at this point?
Yeah, you saw a little bit of it in the fourth quarter when the rates declined to in the 370s. You saw small caps respond very, very positively. I think other financial conditions have eased a bit, which is also helpful for small caps. And I do think that a little bit more rate clarity will be a nice tailwind for the group. We may not get that this week, but I think it's something that we should get more likely in the second quarter.
Okay. Let's talk about what you like. And you like the consumer sector. You're all bulled up, you say, about the consumer. Why? What do you see that is so convincing to you that the consumers will continue to spend?
I think the consumer has chosen, very, very broadly with their feet in terms of how they spend their money. And you mentioned two of them. We like the restaurant theme a lot. And Shake Shack and Cava are two of them, two companies that are really focused on not just menu, but loyalty. And they're run by management teams that have been very, very efficient on the real estate side of things. Shake Shack has, went through its own troubles before they kind of corrected themselves, and we think the new management team will be helpful there. But Cava has, really learned from the mistakes of the past, and I think that that's one that's set up quite well for the future.
Full disclosure, I worked at Shake Shack. I have to say that, right?
That's true.
And we've been collectively bullish, but how do you wrap your head around valuation? Because it is not a cheap stock at these levels.
I think that there's a bit of under earnings, in what's gone on there, and I think that what you'll see as we move forward is a bit bigger ticket, and I think you're going to get a little bit more on the growth side in terms of units that are out there. I think that they're a bit behind the curve on units as they're waited for the management change to go through. So it's on present numbers, it's not cheap at all. But I do think if you look out 2 years and you start to see something that more aligned with the growth rate that we're looking for.
Greg, we obviously spent a lot of time talking about debating, as everyone is right now, about inflation, inflationary inputs, and the like here. When you think about your sector, they're obviously a bit more sensitive, let's say, to larger cap stocks, and especially with higher rate environment and the like here. What's your outlook right here? And obviously, you pick small caps, you put them in your ETF here. We spent a lot of time looking at the Russell 2000, which is 2,000 stocks here. But are you optimistic, about a broader swath of stocks rather than the ones you're just looking at?
Yeah, I think that what we try to look at is, within the Russell 2000, you have a lot of stuff that you probably don't want to own. There's a significant amount of unprofitable companies. You had a large number of SPACs in there for a long period of time. That's starting to slowly drift away. You have a lot of rate-sensitive companies that we don't really kind of get into in the REITs and the utilities and things like that. So if you look at some of the names that not necessarily are at the largest part of the benchmark, but in the sort of the $2 to $5 billion range, where you can find some of the companies that can make their own weather. You mentioned consumer. We like the semiconductor space a lot. I do think that some of the areas in healthcare, some med tech names that we like. These are companies that have gone through an earnings recovery that started to go down 2 years ago before the large cap guys. So I think that these companies can respond favorably, as some of the tailwinds and headwinds balance out a little bit more. But I do think that you have to be very selective in small caps because things can go down with great velocity.
In semiconductors, do you need to see the NVIDIA story slow down in order for that specific subsector to do well? I mean, are these AI sort of semiconductor stocks or AI adjacent?
AI adjacent, I'd say. I think that some of the companies we own, there's a company went public a few weeks ago called Astera Labs that we invested in. We knew the company, for a couple of years before they went public, so we were eager to invest in that one. And then other companies like Cohu and Onto Innovation, we think can benefit from just a large recovery in chips and things like high bandwidth memory, which is an analog to NVIDIA's growth. You need that high bandwidth memory to make those AI machines hum.